Welcome to another episode of the Money Bru. How do you invest your savings on a monthly basis? Now, as a quick rule of thumb, and something that we're going to be discussing in a future video to come, is the allocation of savings on a monthly basis. Now, before diving into all of the detail, which we cover in a new episode, at a very high level, let's start with the allocation of 20% of your monthly salary is going to be allocated to savings. So if you're earning 10,000 Rand, 10,000 dirham, $10,000, 10,000 pounds a month, let's assume 2,000 of that is going to be allocated towards savings. Now, a very important principle that we discuss in this future video, but is really relevant now, is to understand the mindset change that needs to occur. So you need to be viewing this 20% savings not as a residual figure, i.e. at the end of the month, whatever I have left will go into savings, but rather a mandatory non-negotiable amount that is paid on day one when that salary is received. So if you're receiving your 10,000 straight away, we're allocating now 2,000 of that towards our savings and investments. Oh, hi there. Just a reminder, this is not financial advice. This is purely just some tips and tricks from my personal journey that I think can help you on building your personal wealth. Now, with that being said, let's move on to what do you do with this 20% investment. Today's episode is going to be split into two key parts or two fundamental parts. The first is risk appetite and risk tolerance. And the second is then using that information and helping us determine how we're going to balance our portfolio based on our personal situation. Risk appetite is essentially looking at a bunch of factors that are affecting your life that will change your risk appetite. And this takes into account age, how many dependents you have, how many kids you're putting through school. There are a lot of different factors that go into risk tolerance, i.e. how do you feel about making risky investments? If you're the type of person that can't wake up in the morning and see a huge dip in a high risk investment, then maybe that's not the investment that you should be looking at. Now, with that being said, we've come up with a really helpful guide that you can access in the description below that essentially is a very short and concise guide that helps talk you through the different components of risk appetite, helping you understand where you fall on that spectrum. Now, at a very high level, and just as an example, someone in a very high risk appetite segment of that scale is potentially in their early 20s, 30s. They're going to be more focused on high risk, high return investments. It's unlikely that they're going to put 90% of their portfolio into a fixed savings account.
I live my life a quarter mile at a time.
Equally, on the other end of the spectrum, on the low risk appetite, someone at 55 to 65 is unlikely to be putting 90% of their savings into a cryptocurrency. So with that being said, I highly recommend you take a look at the link in the description below and work out first what your specific risk appetite is and what you're comfortable with in terms of investing.
Okay.
Now, with that part covered, let's move on to the exciting part. What do we do with that money? Now, there are so many videos out there that I've watched where it only talks about the allocation of your savings, and it puts everyone in the same bucket, assuming everyone is coming from the same starting point. So if you are a high risk appetite, you might be putting 60 to 70% into volatile equity or stock investments. So I want to take it a step back, because I believe that everyone is in a different situation when you're watching this video, when you're starting to improve your personal finances. So the first thing that I would focus on is your emergency fund. Now, what is the emergency fund? That is there for a rainy day. It's liquid cash, i.e. it's cash that can be accessed very quickly in case of an emergency. Now, as a rule of thumb, you should be looking at around 3 to 6 months, in some cases 12 months, if you need to be really careful. But it's 6 months of no income is a good rule of thumb for what you should be putting into your emergency fund. So if you have 10,000 income, for example, we've allocated 2,000 to savings and the remaining 8,000 is your monthly expenses. Let's assume 6 months of monthly expenses at 8,000 is 48,000, which needs to be accounted for in your emergency fund. So the starting point is from today, all of the money that you allocate into your savings, make sure that that emergency fund is at the level that it needs to be. So the first allocation of those funds is towards your emergency fund for a rainy day. Now, once that emergency fund is filled up, where does the rest of our savings and our investments get allocated? Let's start with what types of investments can be allocated into. Now, there are a range of different investments, but I'm going to be focusing on 5 kind of main types. First, just talking about cash and emergency fund, which we've spoken about already. The second is equities, which is investing in the stock markets and ETFs. You then have real estate as an investment. You have government bonds. You have alternative investments. Now let's dive into a bit of a high-level overview of each of these. Please, if you do want us to deep dive into any of these topics specifically, drop us a comment below or drop us a DM, and we'll be sure to come up with a video focusing on any specific asset class that you want us to look at. But at a very high level, you've obviously got your cash, which is your fixed low return, but it's a safety pot and it's accessible. It's your emergency fund. You've then got your equity investments. Now, obviously, it depends on what type of stocks that you're investing in. Some will be higher risk, some will be slightly lower risk, but your stocks are essentially there for capital growth. So they're going to be looking for capital growth, high risk, high return investments. Your government bonds, this is a great, more stable and secure income stream. Why? Because the risk of default at a government level is far lower than something on the stock market. Your government bonds is essentially a mechanism where the government is borrowing money from you and in return paying you an interest coupon. So that is a stable cash flow that is a slightly lower risk and another important part of the portfolio. The third is real estate. So real estate generally from a perspective of buying to let. So you purchase real estate and you rent it out for an income. And finally is alternative investments. It's kind of the cash or for what I would consider your cryptocurrencies, investing in startups, and also something which I think is often overlooked is investing in yourself. Investing in your own businesses, investing in your own startups. So considering this whole kind of bundle, how should you be allocating your savings into each of these buckets? Now, for today's purposes, we're going to be focusing on kind of two ends of the spectrum. And as I said, this is really going to differ completely based on your personal risk appetite. But as a rule of thumb, we're going to be talking on the high risk side of things and the low risk side of things. So if you are in the high risk bucket, you're in your 20s to 30s, you can be more aggressive, you have less to lose. Your weighting is going to look a little bit like this. You'll have 10% into your cash and emergency fund. So before we spoke about having 6 months of expenses into your savings. Naturally, as your wealth builds up, you should look to increase that slightly to balance your weighting of your portfolio to maintain that at around 10%. So you can keep topping that up to make sure you always at the 10% level in your emergency fund and your cash fund. The next is your equities. If we're on the high risk side of it, you're looking at around 60 to 70% that I would recommend going into the stock market and investing in the stock market. Your government bonds, closer to 0 or 10% is a rule of thumb. If you at high risk investment, there's not necessarily a need for this at that stage. And then potentially 10 to 15% across real estate and 10 to 15% across alternative investments. Now, on the other side, the low risk side, that's going to be flipped around with a lot more emphasis on government bonds, potentially 45, 50%. Your investments in equities will reduce down to around 20 to 30%, and then around 10 to 20% on real estate and a much lower amount, maybe 5 to 10% on alternative investment. Now, it's also really important to consider any government initiatives based in your specific country. So depending on your geography, so if you're in South Africa, this will be your tax-free savings account, your TFSA. If you're in the UK, this will be your lifetime ISAs. Or if you're in America, this could be your 401k. So these are initiatives that the government has specifically put in place to help people with their savings. So take advantage of these systems. For example, if you're in South Africa, the maximum allowance is 36,000 Rand per year. Max out that allowance every year. Why? Because you're saving yourself the capital gain on those investments.
Use my knowledge, I beg you.
So in a nutshell, wrapping it all up and bringing this episode to a close, you first need to understand your specific risk appetite. You can then open up our Excel template, which has got the different weightings across the different asset classes that we've discussed. And then you're looking at allocating your portfolio across those different asset classes. Now, hopefully today, you've learned a little bit more about how you should be allocating your savings on a monthly basis. Finally, please, we open ourselves up to questions on this channel. If you've got any specific questions in terms of deep diving into any of these asset classes that we've discussed, or just the process around how to invest in stocks. It's one thing to talk about allocating percentage of your portfolio. It's another aspect, opening up that account and actually buying that investment. Similarly with government bonds, if you're looking to understand what is the actual process to go and purchase bonds, or where do I go, what do I do, please let us know and we'll be more than happy to shoot another video and answer any questions that you have. So now that you're on this journey, check out this video next.